this video, I'll cover the exercise called cost of capital, the three tables for relevering or unlevering. Here. You'll see that I'll likely split this video into two, but let's get started. So in this course here, you will find in previous exams that this is really one of the parts of curriculum that can make, at least from my experience, a lot of students nervous because there are some fairly complicated formulas here that you need to be familiar with and also to some extent memorize. And that has very much been tested in previous exams. But let's read this together and then work slowly through it so we also understand it. At t equal to 0, ABC is completely equity financed and is expected to produce a yearly cash flow of 430.76924 million DKK before taxes in perpetuity. ABC's asset beta is 1.2, the risk-free rate is 2%, and an asset with beta 1 has an expected return of 7%. The expected marginal corporate tax rate is 35%. Assume that debt is risk-free and independent of corporate finance policy. Okay, good. So maybe just a question for you to sort of reflect on before we jump in. Do you know the answer to whether are tax shields always risk-free, even if the underlying debt is not or potentially risk-free? The answer to that is that the debt can be risk-free, but you can actually have that the tax shields are not. And we'll get back to this, but that is actually at the heart of why we need these different methods of relevering and unlevering all that. But this was just a teaser to get us started. But let's actually jump into question 1 here. In question 1, it says, if ABC is debt financed with 2 billion DKK that is held constant over time, what is the value of ABC? Value of ABC. Right? So that the information that was given in this particular question is that we have debt is equal to 2 billion DKK. And now I ask you, how do you find the value of ABC? Most people, from experience, when I've done this exercise with students, they immediately jump to the thinking that we need to use these three tables and all of these things, which there was so much focus on in the lecture. But for this question, we actually don't need to do that. It's much simpler. Because remember that the goal of what we're trying to do here is to find the value. What is the value of a levered firm? I really like to start off by writing out the formula for what it is that we're trying to find. So if I'm trying to find a value of a firm, I know that the value of a levered firm, right, there's debt here, right? So the opposite of levered is value of unlevered. But now we actually have value of levered firm is equal to the value of the unlevered firm plus the present value of tax shields. Good. This I can find because I can, for example, start by saying, what is the value of the unlevered firm? So if I assume that there's no debt at all, then how do I price something like this? Right? I take the cash flows, and it says in the exercise, I was trying to scroll up to the text, but I actually don't have that here. So if you have the text beside you, it says that it generates some cash flow, right, in perpetuity. So the value of the unlevered firm is probably going to look like something like this. So now we just need to find what is C and what is R, and then we can fill out this part. So then we're off to a good start. So if we start by R, then in the exercise, it said that we have an asset beta of 1.2, risk-free rate is 2%. Okay, so we're probably supposed to use CAPM here, right? So risk-free rate is 2%. Good. And then we have an asset beta of 1.2. Then it says that an asset with beta 1, and we know from our theory that the market has a beta of 1, right? So this is actually the asset, the return on the market is 7%. And then I subtract the 2%, right? So I get the market risk premium. So I get that my cost of capital is 8%. Right, so now this one is checked off. What is my cash flow? And here you need to read the text, and it says that a yearly cash flow of 430,76924 before taxes, which is one place where people go wrong, right? So basically, when I'm supposed to find my value of the unlevered firm, I need to discount with 8% that I just found, and then I need to say take the 430.76924, and I need to get the after-tax cash flow, right? And I'm told in the exercise that taxes is 35%. So if you calculate this, you actually get 280 or 8%, and then you get this lovely round number of 350, or 3,500,000,000, that is, right? Because this was in million. So this is still in million. Good. So now this part is checked off. So now we just need this part. So how do I find my present value of tax shields? Well, we've also been taught that the present value of tax shields is actually, if I keep my debt constant, which it says very explicitly in this exercise, it says if ABC is debt financed with 2 billion in debt that is held constant over time. If something is held constant, then I've been taught that this is actually just the value of my present, of my tax shield. And if you just want to understand why, then let's just think. So you don't necessarily need this in your notes, but how do I price something? If something is held constant, right, then it's the perpetuity formula, like this, right? So I know I need to discount with the cost of capital, which is going to be my return on debt. What is the cash flow each year? Well, I have some debt, right? I pay interest on that, and the amount of interest that I pay is RD, and this is then tax deductible, right? So when I do this, these cancel out, and I'm left with TOD, or T times D, like that. So that's basically how that is derived, that formula. But now we can use that formula, right? So this is super handy to know this very, very simple fact. Now we can use this to say that you have a tax rate of 35% and you have debt of 2 billion. So basically our present value of tax shield is then 700 million. So our value of the levered firm is then equal to 300 or 3,500 plus 700, which is equal to 4,200 million. And notice in this exercise that we were not giving any debt over equity ratio, right? We were not given this basically, which makes it really hard to do this unlevering and so on method. So there should really be a hint that there must be an easier way, which is what we just did. Then let's jump to question 2. Use Modigliani and Miller, so M&Ms, to argue why value of the levered firm can vary from the unlevered firm. So basically Modigliani and Miller and value of levered firm versus value of unlevered firm. And here, I also just want to give you a good thing to remember. So I'll write key, because Modigliani and Miller, right? So they are basically super famous in finance. They wrote this paper in the 1960s that have been cited and read by so many people, right? And they basically show that in a frictionless world, then capital structure doesn't matter. Good. So this is also something that has been tested quite often in memos in this exam and could very well be tested again in the future. And I just want to give you a really good sort of small trick here, is to always start your argumentation with in a frictionless world, and then blah, 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 blah. Because that's basically what they did. And why their paper is actually, even though, it's far from reality, is actually super useful and super elegant. Because what they say is that in a frictionless world, right? And frictions, just so you are aware, so frictions are, for example, taxes, cost of bankruptcy, right? So distress and transaction cost and all of these things that makes the world complicated, emotions and so on. They say in a simple world, in a world without frictions, then the following holds true. And then because you have this simple world, then you can then very analytically add different things or introduce different things into your world, for example, taxes, and then see in isolation how that influences your world, right? And I think what I just said there is quite key, right? So it makes your argumentation so much more elegant and fluid if you start with something like this. So I would just say in a memo, whenever you can, use this kind of phrasing. It will make it easier for you, and the teacher, I hypothesize, will really, really like it. I would. Basically then, so in this one, let's write an answer. The answer is that in a frictionless world, as discussed by Eminem, right, Modiani Miller, the value of the firm is independent of financing decisions. So basically, it doesn't matter if you take on more debt or not. Right? So basically what it says here is that value of levered firm is equal to value of unlevered firm. You cannot change it by changing your financing. However, when we introduce frictions, e.g. taxes, financing decisions can affect firm value. For example, you can have that the value of the levered firm is now larger than the value of the unlevered firm. Good. So for example, in a previous exam where you had a memo that was titled, "Does Debt Matter?" then you should think that, okay, they're probably referring to Modiani Miller, and I would always start my argumentation with this. That's a really elegant and strong way. Good. Question 3, and then we'll break after this, so we'll stop the video and do a new one, but let's do question 3 in this one as well. How will the valuation from question 1 change if tax suddenly increases to 60%? Okay, so value from Q1 if tax increases to 60%. Good. So here, if this was a in-person course, I would ask the class, what do you think is going to happen here? And then I would actually get quite mixed results, because people would, and I encourage you to maybe pause the video here and just work through it, or maybe just think through it. What do you think is going to happen? People would look at this up here, this right here, and then they would say, oh, when my tax rate goes up, then the present value of my tax shield increases because of this formula. Therefore, my value of the levered firm probably goes up. Just think about that for a second. If taxes go up, then you pay more to the government. Do you really think that the value of the firm actually increases? And it's very common that you make that mistake if you sort of don't maybe just reflect on whether that actually makes sense or not, right? But think, you have a company, right? This right here is a company. It produces some cash, and now government comes and takes 60% instead of 35%. You are left with less cash flow. You would think that the company is worth less to you. And that is also the right result. So the way that you should do this is that you actually need to calculate the entire thing again. So let's actually start with that. So you know that the value of the levered firm is equal to value of unlevered plus present value of tax shield. And most people just think that tax influences here, but it doesn't. We know that the value of the unlevered firm was 430,76924 minus tax, which is now 60% over 8% here, right? So when you do this, you get this number. And then present value of tax shield, well, let's actually just do it in one step here. But then my value of the levered firm is then this thing here. I can see I made a small typo. This is the value of the unlevered firm. Right, so this is critical that you see that, right? So the value of the levered firm is then the value of the unlevered firm plus the value of the tax shield, where you now use the new tax rate. And you have that the value of the levered firm is now this, right? So it basically ran down to a bit more than 3 billion, but went down from a bit more than 4 billion, right? And the reason, of course, is that you had that the value of unlevered went down a lot, right? So it didn't really matter that the present value of tax shield went up, right? This is obviously larger than before, but this is much smaller than before. And that effect will always be the strongest in this sense, which makes sense, right? So we see that value decreased as taxes were increased. Good. And if you do an exercise like this in Excel, and instead of hard copying your cells, you actually link them together, then you would also get rid of doing a mistake like this one. But I've seen it many times before. I'll pause the video here, and then we'll come back and do question 4 and the remaining questions, where we'll talk of the 3 tables.